Most businesses in the modern world celebrate when they reach a modest 15% profit margin. After paying off their overhead, their employees, and their constant operational expenses. But buried deep within the backbone of the global telecommunications system lies an elite group of companies operating on a mind-bending baseline profit margin of over 80%. They don't design trendy smartphones. They don't sell expensive data plans. And they certainly don't care which wireless carrier you choose. Yet, they quietly siphon billions of dollars out of every single phone bill paid on Earth every single month like clockwork. This isn't an accident. It is a mathematically engineered financial machine. And the secret behind how these companies turn simple chunks of steel into 80% margin cash printers is something almost everyone completely misses. To understand how this economic engine generates such insane returns, you first have to dismantle the massive misconception surrounding modern mobile networks. When you see a giant cell tower standing beside a highway, your brain naturally assumes it belongs to AT&T, Verizon, or T-Mobile. But it doesn't. Decades ago, wireless carriers came to a staggering realization. Owning physical infrastructure was an absolute cash-burning nightmare. Every single tower required land acquisition, heavy construction, regulatory compliance, structural maintenance, and insurance. It was a massive drag on their balance sheets. So, they pulled off one of the greatest stealth sell-offs in corporate history. They sold their physical towers to neutral infrastructure companies and instantly rented them right back. But why would wireless giants voluntarily hand over the ultimate leverage to third-party landlords? The answer reveals the foundational mechanics of an economic model that is nearly impossible to break. When an infrastructure company like American Tower or Crown Castle decides to build a new cell tower, they spend a massive upfront sum. Constructing the steel spire, running power lines, and securing the ground lease can easily cost hundreds of thousands of dollars. When the first tenant, let's say Verizon, hangs their heavy equipment on that tower, they sign a long-term lease. At this point, the tower is barely profitable. The single lease covers the ground rent, the routine maintenance, and the initial financing costs, leaving a thin, unremarkable margin. If the business model stopped right there, it would be a slow, boring, capital-intensive utility investment. But that's where the financial magic trick happens. Because the tower company built that steel spire with massive structural headroom, once the structure is standing, adding a second tenant costs almost nothing. The ground lease under the tower doesn't go up. The heavy concrete foundation is already poured. The zoning permits are already granted. So, when T-Mobile approaches the tower owner and asks to attach their own equipment to the exact same spire, nearly every single dollar of that second rent check drops straight down to the bottom line. Think about that for a second. With one tenant, the operating margin might sit at a modest 40%. But add a second tenant, and the margin shoots past 70%. Add a third tenant, and the operating margin explodes beyond 85%. It is the ultimate real estate multiplier, adding whole new floors of high-paying commercial tenants, without ever having to buy a single new square foot of land. Yet, holding high-margin assets is only half the battle. The real secret to their absurd profitability lies in how they lock in their cash flows, using a mechanism that completely insulates them from economic crashes. In almost any traditional business, if a recession hits, customers cancel subscriptions, renegotiate terms, or walk away entirely. But in the cell tower ecosystem, leases are structured like ironclad financial fortresses. Carriers sign non-cancelable leases that typically span 10 to 15 years. Let that sink in. A tenant cannot simply pack up their equipment and leave next month without triggering catastrophic financial penalties. And it gets even better. Buried inside almost every single lease agreement is an automatic, non-negotiable yearly price escalator, typically around 3% in the United States, or pegged directly to inflation metrics internationally. That means, while other businesses are struggling to raise prices during volatile economic cycles, tower companies receive automatic, compounding pay raises every single year. Without lifting a finger, it creates a predictable, upward-sloping revenue curve that makes traditional stock market investments look chaotic by comparison. So, If these towers are essentially legal money presses, why doesn't a rival real estate developer just drop a competing steel spire right across the street and undercut their prices? Here, what most people completely fail to grasp. You cannot simply build a cell tower wherever you want. Local municipal authorities, zoning boards, and neighborhood associations treat new tower proposals with extreme hostility. Obtaining the permits to drop a 200-foot steel structure in a populated suburban area can take years of legal battles, public hearings, and astronomical administrative costs. This creates an invisible, yet practically impenetrable, regulatory moat around existing towers. Once a tower company secures a permit and constructs a tower in a prime signal area, they hold an absolute regional monopoly over that specific slice of the sky. If a carrier wants to provide coverage to the households in that valley, they don't have a choice. They cannot build their own tower, and they cannot let their network go dark. They must pay whatever the existing tower owner demands, or watch their customers defect to a rival carrier with better coverage. However, just when this business model sounds entirely invincible, a sudden structural shift rocked the entire sector, exposing a massive hidden vulnerability that caught Wall Street completely off guard. Because these companies build their massive empires using heavy amounts of debt, they are extraordinarily sensitive to global interest rates. For over a decade, cheap money allowed tower giants to borrow billions at near-zero interest rates to construct spires, buy out smaller competitors, and aggressively expand their global footprint. But when central banks rapidly hiked interest rates, the cost of servicing that massive mountain of debt suddenly exploded. At the exact same time, the major carriers finished their initial, hyper-aggressive capital spending wave for 5G infrastructure. Suddenly, the golden era of rapid tenant additions began to cool down. Tower companies were left facing dramatically higher borrowing costs, while their explosive top-line growth began to normalize. This created a terrifying paradox for investors. How do you maintain an 80% operating margin? When the cheap debt funding your expansion suddenly dries up, the answer to this crisis is forcing the industry into its most lucrative pivot yet. As the world rapidly shifts toward higher-frequency 5G networks, automated vehicles, and real-time artificial intelligence processing, old-school macro towers are no longer enough on their own. High-frequency signals can carry insane amounts of data, but they can't travel long distances, and they struggle to pass through solid concrete walls. To solve this, tower giants are quietly transitioning from massive steel towers in open fields to microscopic infrastructure nodes scattered throughout major urban centers. They are signing master lease agreements with major cities to secure exclusive rights over light poles, traffic signals, and building rooftops. These tiny, hidden devices, known as small cells, are being deployed by the tens of thousands, and just like their giant steel predecessors, the business model remains identical: secure the prime physical real estate first, and then rent that exact same tiny node to multiple competing tech and telecom companies. Every smart car negotiating an intersection, every mobile artificial intelligence query, and every single connected device in tomorrow's smart cities will rely on an invisible network of small cell toll booths. When you step back and look at the broader economy, society is constantly chasing the next big tech breakthrough. Investors gamble on high-risk software startups, volatile smartphone manufacturers, and unpredictable consumer trends.